Yay. Okay.
All
All right.
right,
I'm
we're
just going
on.
to jump in then.
Perfect. Go ahead.
Okay. Hi, I'm Autumn Blackledge. I'm here with my very good friend, Joseph McNair. He and I have known each other for quite a while, and he is an employee of Warren Averett. He's going to tell you a little bit about what he does, and we're going to talk about some things that might be relevant to you and your case and your future amidst this COVID-19 pandemic. Joseph?
Thank you, Autumn. I appreciate that. And I know you know, but for the audience, we are fee-only financial planners. So we do investment management across the spectrum, but my primary focus is high net worth families. And we do investment management and fee-only investments. One of the questions we're getting a lot right now, and I think as you and I discussed this call, that we're seeing frequently is, what should investors be doing right now? What do people do in the midst of this pandemic? One of the most challenging things, and probably our best advice, is to just be still. When the world's moving around you at the pace and veracity that it is right now, taking a deep breath and being still is probably the most challenging thing. But I think the best advice we can give is don't let short-term phenomena impact your long-term planning. So things are moving so rapidly, but a lot of what's moving is short-term, and we know we're going to get to the other side. So if your long-term goals haven't changed, neither should your planning. So step one is to take a deep breath and just be still.
So if I were going to break that down just a little bit for clients, if they had planned on retiring at age 65, they shouldn't panic and all of a sudden think, well, now I'm going to have to work till I'm 75, or I need to move everything around, or I need to sell my stock to be able to live. You're saying keep your long-term plan, basically until we have to change our long-term plan.
That's exactly right. If your long-term plan hasn't changed, this activity that's going on in the market, we fully expect to be short-term, and we shouldn't make adjustments to our long-term plan based on what's going on here in the interim.
Now, what about what can you do if during this period of time you do feel like you need to make some adjustments, not to your long-term plan, but maybe to your daily activities? Do you have any suggestions for what you could do that would make you feel a little better?
Yeah, absolutely. There are some proactive steps that you can take. And to kind of summarize those, the big picture, what you can do is take the opportunity to reset your balance sheet. So we're not talking about changing long-term plans, but we are talking about resetting your cash reserves. As a general rule, we recommend 3 to 6 months of your household expenses ought to be set aside in a cash type investment that's not subject to market risk, and it's there for emergencies. So we find that a lot of people, if you're fortunate and your income hasn't changed, your expenses probably have gone down as we're all sitting at home, not going out. So you may find yourself at the end of the month with excess cash that you're not used to. So it's a great opportunity to rebuild that cash reserves or build towards a cash reserves that is 3 to 6 months. And in a time like this where things are a little more uncertain, lean closer to that 6-month cash reserve. So step one, a great opportunity to reset your cash reserve. Step two in resetting your balance sheet is to reset your debt. So interest rates right now are historically low, and it's a great opportunity to consider refinancing if you haven't. So get an understanding of what your current interest rates are. If you're a borrower today, you may have an opportunity to refinance and potentially save hundreds of dollars a month, and that could free up cash flow on a monthly basis. Alternatively, you might change the term of your debt, say from a 30-year mortgage to a 15-year mortgage, and make small changes that are going to save you money and over the long term help you accomplish long-term goals. Like, I can pay off my mortgage potentially 15 years sooner. So a great opportunity to hit the reset button. And the final reset I would do is take the opportunity to reset your investment allocation. So typically with long-term investors, we set an investment allocation based on their time horizon and their long-term planning and their risk profile. But as stocks decline in value with volatile markets like we're on right now, likewise when stocks go up with great markets, the allocation gets out of alignment. So right now you may find that stocks are a smaller percentage of your portfolio than your target. So it's a great time to reset that investment allocation, sell some of the bonds and cash that have done well, and buy stocks that essentially right now are at a discount.
And we're seeing lots of, we're not heading into this stock market crash where people can expect that everything goes to rock bottom prices and stays that way. I mean, you're where what you're hearing in your circles is this going to tick back up and we're going to have a normal stock market and things are going to maybe not increase quite as quickly as they did at some points in time, but we're going to be back on secure financial footing. Is that what you're hearing?
Yeah, that's absolutely right. Now, we can't predict the bottom of the market. That's a challenge for sure that we just can't overcome. So in the short term, the market very well may go up, may go down in the short term, but we are confident that over the long term, fundamentals are going to come back into play. And once we get past the hysteria of COVID, the market will return to normal. We're optimistic that that'll be quicker than probably some of the more pessimistic pundits out there. But we do expect a recovery of this. We expect it to be a full recovery. When the timing of that is somewhat uncertain, but we do expect things to return to what we consider normal for sure.
So if we have, go ahead.
I was just going to say, with that, creates this opportunity as kind of the final step in the what should you do right now. If you've been still and you've focused on your long-term plan, you've taken the opportunity to reset your balance sheet, and you find yourself in the fortunate position to add to your portfolio, I would lean on the Warren Buffett's advice. He says to be greedy when others are fearful, and this is exactly that opportunity. I don't know that in my career that we've ever seen fear like this. Dating in the 2008 crisis, certainly we have, but this is the most fearful time that we've been in some time, and savvy investors would say it's a great time to add to your portfolio. So if you're in the fortunate position of having surplus, it's a great time to add to your portfolio.
Yeah, it seems like in 2008 that market dip really affected certain sectors, and the fear went to certain sectors as opposed to maybe the general population. Well, now we're seeing something really unprecedented, that everyone from a minimum wage worker to a Fortune 500 CEO are all in the position where they're nervous about what the future holds, and that's pretty unprecedented. Would you agree?
Yeah, it's very much something that is different than we've seen in the past. It's an entire shutdown of the economy, from Fortune 500 companies to hourly workers to just across the board. Work has slowed for many people. Work has stopped. But the other thing that's different about this, first, it was very sudden. Second, it was intentional. We shut down the economy on purpose. And again, it was for something that we believe is short-term in nature. So it's certainly a unique challenge. It's different than we've seen before. Those types of uncertainties are what makes predicting the bottom unlikely. But we do believe that it's short-term in nature, and in the long run, it's going to play out.
Now, we've talked a little bit about what you could do if you find yourself in the position where you have some excess cash. You've done what you needed to do to reassign debts and maybe refinance. But what if, while my clients are watching this and people out there who may be seeing this video just find themselves in this emergency state where, maybe their unemployment checks haven't come yet. They certainly don't have the SBA loans quite yet. And so cash is tight, and they're really just worried about how to pick up food at the next, at the grocery store run. What are some things that you know of that they can do if we really need an emergency, if you need to access emergency money?
Yeah, you're absolutely right. We want to be mindful of people are facing real financial emergencies, and there's a lot of people out there that are in that situation, and there are some things that you can do. And in fact, there are some changes with the new legislation that make that a little bit easier. But before we get to the legislation, the first thing to do is to use that cash reserve. So we talked earlier about having a 3 to 6 month cash reserve. And if you're in the fortunate position to have built a cash reserve, this is the time to use that. It's why you built it. This is the emergency that it's there for. So don't be afraid to touch the cash reserve, to use that to relieve an emergency. I think that's exactly why it's there. And then we'll look at rebuilding it when we get to the other side of this. The second thing is, we talked about interest rates being at a historically low rate. It's a great time to look at home equity. Real estate values are still high. So you may have equity in your home. If you were fortunate enough to have already set up a home equity line of credit, then it's a good time to use that home equity line as kind of that second layer of access to liquidity. So a home equity line is great. If not, look into getting a home equity line. Again, interest rates are really low. I can tell you banks are really busy with financing right now across the board and all different rounds of financing. But if you have the opportunity to pursue a home equity loan or a home equity line of credit, it's a good time to do that with historically low interest rates. And finally, as we look at the CARES Act and what it's doing to help Americans relieve this financial emergency, one of the changes relates to borrowing from your 401k. So typically borrowing from your 401k, and even today, it remains kind of an emergency only type situation. But if you find yourself in that emergency and your plan permits for you to borrow from your 401k, there's expanded borrowing capability for 401ks today. So that may be an opportunity for you to look to access some cash by taking a loan from your 401k that you repay over a period of time. And then the final change, the CARES Act has essentially defined COVID-related emergencies as hardships. So that permits you to take what's called a hardship withdrawal from your qualified accounts. If you have an IRA or a 401k, you can take a withdrawal from that. And typically hardship withdrawals are subject to a 10% penalty, and then you have to pay taxes on those withdrawals because you put in pre-tax dollars. So if you take a distribution, you have to pay the tax plus the 10% penalty. So the CARES Act has waived that 10% penalty for COVID-related emergencies. So that's an important benefit. It's also provided the opportunity to pay the tax over a 3-year period, or pay the money back into the IRA. So if I pulled out money and I have 3 years essentially to ratably pay it back. So if I pulled out $30,000, I can pay back $10,000 a year over the next 3 years. And if I pay it back, then I don't pay the tax. If I don't get it paid back, then I have to pay tax over that 3-year period. So there is a little flexibility. Again, borrowing against your 401k, taking hardship withdrawals from qualified accounts are kind of measures of last resort, because that goes back to step one where we said don't derail your long-term plan to the extent you can avoid it. Those two things certainly would have an impact on your long-term plan, but consider all of that together. We would take a full approach, full look at your financial plan as you address or consider how to address emergencies.
Well, thank you so much. I really think that's going to help. And I certainly have always appreciated your advice, your guidance in cases and other areas in which we've had an opportunity to work together. I know you guys are doing really amazing things at Warren Averett right now, and building and always growing over there. So I know that your long-term goals haven't changed to become, the go-to financial management company in our area and across the Southeast. So for that, I applaud you guys that y'all are sticking with your plan. And I really appreciate the time.
Autumn, I certainly appreciate it. Thank you very much for all that you and I get to do together. I appreciate our relationship, and thank you again for having us on the call, and know that if there's any more we can do for you, we're always happy to.
Thank you so much.
All right, take care.
All right, bye-bye.